Alternative investment structures introduces the organizational and economic frameworks used in alternative investments within the program. Alternative investments differ from traditional investments because they generally involve lower liquidity, higher fees, longer investment horizons, and more specialized management expertise. The major categories include hedge funds, private capital, and real assets such as infrastructure, commodities, and real estate. These investments are often pursued for diversification benefits because their returns tend to have lower correlations with traditional stock and bond portfolios. However, during periods of market stress, correlations may rise unexpectedly. Investors therefore use alternative investments carefully to improve portfolio efficiency while balancing liquidity needs, complexity, valuation uncertainty, and operational risk. A central concept in the topic is the distinction among direct investing, co-investing, and fund investing. Direct investing occurs when an investor independently purchases and manages an asset without relying on an outside manager. This approach provides maximum control and potentially lower fee burdens, but it requires significant expertise, resources, and due diligence capabilities. Fund investing pools investor capital under a professional manager who selects and oversees investments according to a predefined strategy. Co-investing combines both approaches by allowing investors in a fund to invest additional capital directly alongside the fund manager in selected deals. Fund investing is generally preferred by investors lacking specialized knowledge, while institutional investors with extensive internal capabilities may favor direct investing or co-investment opportunities. Alternative investment structures are commonly organized as limited partnerships, where the general partner, GP, manages the investment strategy and the limited partners, LPs, provide the capital. The GP is responsible for sourcing investments, conducting due diligence, managing operations, and eventually exiting investments profitably. LPs, on the other hand, typically have limited liability and limited involvement in day-to-day decision-making. These structures are often available only to accredited or qualified investors because alternative investments are lightly regulated relative to public securities markets. Investors usually commit capital upfront, but the funds may be drawn gradually over time through capital calls. This arrangement allows managers flexibility in timing investments while ensuring that sufficient capital remains available for future opportunities and operational needs. Compensation structures are another critical aspect of alternative investment arrangements. Managers generally earn both management fees and performance fees. Management fees compensate the GP for operational oversight and are usually based on assets under management for hedge funds or committed capital for private capital funds. Performance fees, often called incentive fees or carried interest, reward managers for generating profits above specified benchmarks. These fees align manager interests with investor outcomes by encouraging superior performance. However, they can also create incentives for excessive risk-taking if not carefully structured. The classic 2 and 20 arrangement, consisting of a 2% management fee and a 20% performance fee, remains common in the industry. Investors must carefully evaluate fee arrangements because they significantly affect net investment returns over time. The topic also emphasizes hurdle rates and high watermarks, which are mechanisms designed to protect investors from excessive performance fee payments. A hurdle rate establishes the minimum return level that must be achieved before performance fees are charged. A soft hurdle allows managers to receive fees on the entire gain once the hurdle is exceeded, while a hard hurdle permits fees only on returns above the hurdle threshold. A high watermark ensures managers cannot collect performance fees repeatedly on the same gains after losses occur. This provision protects investors by requiring the portfolio value to surpass its previous highest level before additional incentive fees are earned. These mechanisms help align incentives between investors and fund managers while discouraging excessive compensation during volatile performance periods. Waterfall provisions determine how profits and cash distributions are allocated between LPs and GPs. Under an American-style or deal-by-deal waterfall, managers receive performance fees as individual investments are sold profitably. This structure benefits managers because compensation is received earlier, even if later investments generate losses. In contrast, the European-style or whole-of-fund waterfall requires LPs to recover their full invested capital and hurdle return before the GP receives performance compensation. From an investor perspective, the European structure is generally more favorable because it better aligns manager rewards with total fund performance. Understanding waterfall structures is essential because they significantly affect cash flow timing, manager incentives, and investor net returns throughout the investment lifecycle. Clawback provisions provide an additional layer of investor protection within alternative investment partnerships. These provisions allow LPs to recover previously paid performance fees if subsequent investment losses reduce the overall profitability of the fund. Clawbacks are especially important under American-style waterfall structures, where managers may receive substantial early incentive payments before later losses emerge. Without clawback clauses, managers could retain excessive compensation despite poor overall fund outcomes. By enabling recovery of excess fees, clawbacks ensure compensation ultimately reflects total long-term fund performance rather than isolated successful transactions. This provision improves fairness between managers and investors and reinforces the principle that manager incentives should remain tied to sustainable value creation across the entire investment portfolio. Overall, topic demonstrates how alternative investment structures are designed to address the unique characteristics of illiquid, complex, and actively managed investments. Limited partnership arrangements, incentive-based compensation, hurdle rates, waterfall structures, and clawback provisions collectively create governance frameworks that attempt to balance risk and reward between managers and investors.